Hello and welcome to Unacademy, a one-stop destination for all the English medium civil service aspirants. Welcome to another session of Economic Weekly Recap, wherein we take all the important economy-related articles which have appeared in different newspapers and analyze these articles. And for this week, the 6 articles that are chosen are listed here. Now, before I start with the first important article, 2 very important announcements. We at Unacademy have already started the Conquer Prelims 2024 initiative. There are 2 components to the Conquer Prelims 2024. The first one is the static component and the second one is the dynamic or the current affairs. Regarding the static, the classes have already started. The polity classes are over. The economic classes are happening on the platform every day 6 p.m. to 7 p.m. Whereas in the context of the current affairs classes, we will be launching the Conquer Prelims 2024, the current affairs component or the current affairs program from tomorrow on the YouTube channel. All you need to do is click on the subscription button, and starting tomorrow from 7:30 the classes will go live from 7:30 p.m. to 9 p.m. on the YouTube. Now, many of you will simply be of the opinion that rather than watching the classes live, you will wait for all the classes to be over and in one shot you will be watching all the classes. Please do not do that. If you keep on postponing, if you keep on procrastinating, over a period of time you will have so many classes to watch, so many concepts to digest, understand. This will become a big burden for you. To address this, the solution is very simple. Every day 7:30 p.m. join us live. Second very important announcement is regarding the special classes. That's a Conquer Prelims 2024 static initiative. Today at 6 p.m. the Indian economy 6th class will be taken by Shyam Kaggod. And if you're wondering who is this particular person, it's me. Already 5 classes are over. 6th class will be held today, 7th tomorrow, so on and so forth. Not just economic classes. In this initiative, the history classes will also be taken. The classes on science and technology will also be taken. The classes on international relations will also be taken. All you need to do is very simple. Go to the profiles of all these faculties. Sarmat sir, myself, Chetan sir, Mukesh sir, Abhishek sir, etc. All you need to do is click on the button follow, so that whenever the classes, that is the special classes, will start, you will get the intimation regarding this. Now, let's begin the discussion for this week. The first very important article: the High Court has refused to interfere in the merger of Lakshmi Vilas Bank with DBS India. What is the story all about? And what are the concepts in this article that you need to be aware, which can be asked in the UPSC examination? Let's start. The banking sector in India, which is regulated by Reserve Bank of India, they are supposed to implement the guidelines by the name of Basel guidelines. Basel 1 already implemented. Basel 2 is done. We are in the process of implementing Basel 3. The Basel 3 guidelines are being implemented in India. Now, within this particular Basel 3, please understand this. There is a capital adequacy ratio requirement. Capital adequacy ratio requirement. And before I go forward, many of the students will say, sir, are we still in the process of implementing? No, the Basel guidelines are very old now. Many of the banks have already met the requirement under the Basel guidelines. And when I say we are in the process of implementing, every now and then, the numbers for the banks, the capital adequacy ratio, are tier 1 capital, tier 2 capital, the requirements will keep on changing, and that is what I meant when I say we are in the process of implementing Basel 3 guidelines. Now focus on this. The Basel 3, under that there is a requirement by the name of capital adequacy ratio. In a nutshell, capital adequacy ratio means what should be the minimum amount of capital that each of the banks must maintain in order to absorb the losses. the capital adequacy ratio further is divided into two components. One is referred to as a tier 1 capital, and obviously the second one will be referred to as tier 2 capital. The basic difference between tier 1 and tier 2 is that tier 1 capital is more reliable. Tier 1 capital can absorb losses much more easily. That's the reason more and more of tier 1 capital is supposed to be maintained by the banking sector compared to tier 2 capital. Now, in case of tier 1 capital, one of the ways through which the banks can raise and keep the tier 1 capital is by issuing additional tier 1 bond. Additional tier 1 bond, AT1 bond. Now, why this is called as AT1 bond? Please understand this. The tier 1 capital is further broken down into two components. One is called as common equity tier 1, and the second one is called as additional tier 1. And that is the reason the bonds which are issued by the banks to accumulate additional tier 1 capital is referred to as additional tier 1 bonds. And on the other side, in case of tier 2, the banks have been allowed in India to issue tier 2 bonds and raise money, raise capital and maintain capital. Now, many of you will ask me, sir, what is the use of this capital? And is there any difference between the tier 1 or let's say additional tier 1 bonds as well as the tier 2 bonds? The logic is very simple here. In case of additional tier 1 bonds, these bonds do not have any maturity period. Please remember, these do not have any kind of maturity period. The bank which will issue these bonds, they will decide when they will recall these bonds. It could be after 5 years, it could be after 10 years. Whereas in case of tier 2 bonds, the bank when it is issuing these bonds, they will specify, they will mention what will be the duration of these bonds. And in case of India, many of these banks have issued additional tier 1 bonds and many banks have issued tier 2 bonds. But the specific nature, which is very important, the nature of these bonds is, in case of let's say tier 2 bonds, because that is there in the discussion in the context of LVB, that is Lakshmi Vilas Bank, the tier 2 bonds, if the bank reaches a position called as point of non-viability, PONV, point of non-viability, that is in essence, the bank after this, if it continues to operate in the same way, the bank might be forced to shut down now. Point of non-viability. If the bank reaches the point of non-viability, under section 45 of Banking Regulation Act of 1949, please remember this, under section 45 of Banking Regulation Act, they can take the approval of Reserve Bank of India and they can write off, they can simply wipe off or write off these tier 2 bonds. In essence, if you have invested into these particular tier 2 bonds, the bank will simply say, I will not give your principal amount back. It is as good as a piece of paper. The bond that you're holding is as good as a piece of paper, doesn't have any value. Now, if you ask me, sir, is it always that they will go for a write-off? Is there any other option? There is also an option of converting that into equity. I hope you understand this. There is also an option of converting that into equity, but in extreme cases, the bank will take the approval of Reserve Bank of India and they will simply write off. This is one very important point regarding the concept of LVB and DSB. Now, what is the second point? The Lakshmi Vilas Bank, LVB, I'll start using the short form now, LVB, over a period of time, because of its management practices, that is, they did not focus on other types of loans, rather they ran behind large borrowers in the market. Because of its wrong management practices, incurred a huge amount of losses. At one point of time, the total amount of losses that they incurred was more than 3,000 crore rupees. The tier 1 capital had turned into negative. More than a fourth of their loan books was under stress. At this particular point of time, they basically cancelled or wrote off the equity that is held by the shareholders. Then they approached Reserve Bank of India. They approached Reserve Bank of India and they took the approval of Reserve Bank of India and they simply wrote off or cancelled all these Tier 2 bonds. And understand this, before this was done, in fact, the Lakshmi Vilas Bank was kept under the prompt corrective action framework of Reserve Bank of India. Despite all of this, it was forced to write off the Tier 2 bonds amounting more than 300 crore rupees, which basically meant the investors, the customers or the investors who had invested in these Tier 2 bonds of Lakshmi Vilas Bank, they would not be receiving even a single rupee, not even a single rupee of their principal amount in these Tier 2 bonds. And after this happened, another bank, DBS India, a subsidiary of DBS, that is a bank in Singapore, went forward and started buying, right? Basically put a proposal to purchase Lakshmi Vilas Bank. And that is when the investors in the Tier 2 bonds went to court. They approached the court. And what was their argument? Their argument was, these investors are similar to the depositors. I hope you understand. These investors are nothing but similar to depositors. Depositors also have given money to the Lakshmi Vilas Bank, and these investors in the Tier 2 bonds also have given money to the Lakshmi Vilas Bank. So they are similar to depositors. On one side, the depositors' value has not been lost. That is, one more bank is acquiring Lakshmi Vilas Bank, and their deposits will be safeguarded. Whereas the investors in the Tier 2 bonds, they have lost all their investments. Their bonds have become worthless now. So they argued that they have been given a raw deal in the whole of the process, and the process was not very much transparent. They approached the High Court, and the High Court very recently has issued an order. What is the order? The High Court said, no, we will not interfere in the decision to sell Lakshmi Vilas Bank to DBS India. Right? That will continue to happen. We will not interfere in that. But on the other side, the High Court also mentioned that whenever RBI does all of these kinds of activities, that is, let's say, write-off of the bonds, again giving approval for the write-off of the bonds, or amalgamation of the banks like this, there has to be a transparency in the process. There has to be a transparency. And that is the reason the High Court has mentioned that, the valuation of the investments have to be done now. Just before the amalgamation, just before the LVB is amalgamated into DBS, the valuation has to be done. And based on the valuation, the Reserve Bank of India has to again find out whether the Tier 2 bonds which have been wiped off, which have been written off, any value can be provided for these particular bonds. That is the order which has been issued by the High Court in the context of LVB, DBS as well as the Reserve Bank of India. So these are certain very important points. Please be very, very careful. Questions can be asked in any of these parts in the preliminary examination. Now, similar question was asked earlier in the examination that was conducted, civil service examination in the year 2018. What was the question? Consider the following statements. Capital adequacy ratio is the amount that the banks have to maintain in the form of their own funds to offset any loss that the banks incur in the account holders if the account holders fail to repay dues. Basic idea. If the borrowers fail to repay the amount, the banks will incur losses. To absorb these losses, the bank must maintain certain amount of capital, and that is basically called as capital adequacy ratio. First statement is correct. Second one is CAR is decided, CAR is decided by each individual bank. How many of you feel this is a correct statement? Because I am asking this, if the decision on the CAR is left out to each of these banks individually, if they are allowed to decide, don't you think every bank will decide will keep a capital adequacy ratio of grand number of 0%, a very grand total of 0%? Because keeping capital adequacy ratio basically means, maintaining that means, you'll have to keep aside some of your capital which you could have used for any other purposes. You are not allowed to touch that capital. So CAR is decided by each individual bank? Absolutely no. The banks do not decide it. In case of India, RBI decides it. And by the way, in the global level or at the global level, the Basel guidelines are recommended by Basel Committee on Banking Supervision, BCBS, Basel Committee on Banking Supervision. So the right option for the question will be option A, only the first statement is correct. Let me go to the next article. RBI orders Kotak Bank to stop adding customers online. Very simple article. Concepts are also very simple. Don't complicate it. Do not read and by heart unnecessary things from such articles. What is the argument here? Under the Banking Regulation Act, there is a particular section, Section 35. Earlier Section 45, now Section 35. According to Section 35 of Banking Regulation Act, if any bank is performing certain activities, certain functions, which are not in the interest of the bank's customer, which are affecting the interest of the bank's customer, then Reserve Bank of India can impose restrictions on the functioning of a bank. Very simple. Is it okay? I'll repeat it again. According to Section 35 of Banking Regulation Act, if a bank is performing any activities which is not in the interest of the customer, Reserve Bank of India has every right to impose or has the powers to impose restrictions over the functioning of such a bank. And that is what exactly has been done by Reserve Bank of India in the context of Kotak Mahindra Bank. And this is not the first time, by the way. I hope you understand this. This is not the first time that RBI is using this section to impose restrictions on the functioning of a bank. Earlier also, many banks have faced the consequences of their actions from Reserve Bank of India under the same section. Now, what is the issue here? Issue is very simple. In case of the banking sector, we follow a system called as Core Banking Solutions, CBS, Core Banking Solutions. What is this idea of a core banking solution? Imagine earlier, before CBS, if I open a bank account in a branch, let's say SBI, right, a branch in a city. Now I will be called as a customer of this particular branch. If I want to operate my account, which is there in SBI, if I want to operate this particular account, let's say from another city, if I go to another branch of SBI, they would never allow me to operate this particular account. Reason being, all my details, all my money, right, all my information is present only in this particular branch. So what has happened? Over a period of time, because of the advent of information technology, now we have introduced a system called as a core banking solution. And if you are worried about what is this core banking solution, it's nothing, it's an application. It's an application, it's a standard, it's a technology which will connect all of these particular banking units. That's it. Any example of a core banking solution? We have banks, BANCS, that is an example of a core banking solution. We also have Finacle, that is also an example of a core banking solution. With introduction of a core banking solution, what they do is basically there's a centralized system, and the centralized server or system will connect all of these branches, whatever be the number of branches. If they are computerized, all of these branches of State Bank of India will be connected now, which essentially means now with core banking solutions, I'm not a customer of a bank. I'm not a customer of a branch. Now I've become a customer of a bank. In simple terms, if I open a bank account in SBI in city, let's say Delhi, can I operate that particular account sitting in Bangalore? Yes. Can I go to a branch apart from this particular Delhi branch? Can I go to any other branch, operate that particular account? Perfectly allowed, and that is possible because of the core banking solutions. But the argument of Reserve Bank of India is that whenever banks will develop these kind of information technology systems, whenever they will have these kind of systems, the banks should also develop mechanisms if there is to control any kind of attacks on these systems. They should also have a let's say the back-end systems should be very well developed. if there is any kind of attack, right, etc., on these kind of systems, there should be sufficient supporting back-end infrastructure or the technology that is developed by all of these banks. And that is exactly the reason why Reserve Bank of India has imposed restrictions on the functioning of Kotak Bank here. Reserve Bank of India conducted certain studies, investigations in simple terms, in the year 22 and 23, and they found that there are no sufficient supporting technology for the CBS system that has been established by the Kotak Bank. And that is the reason in the last couple of years there have been multiple outages in the services which are provided by the Kotak Bank to its customers. And as a result of all of this, who is suffering? The customer is suffering. And that is the precise reason Reserve Bank of India now has stated that despite giving multiple warnings, we have given them multiple warnings, they also gave a response, but the response is not satisfactory enough. The measures or the steps taken by them are not satisfactory enough. And following upon that, RBI now says under section 35, we have ordered Kotak Bank to stop adding new customers and issuing new credit cards as well. Right, so these are certain very important points regarding the second article. Now, based on this, earlier in the year 2016, there was an MCQ asked in the civil service examination. The term core banking solution is sometimes seen in the news. Which of the following statements best describes or describe this term? It is a network of banks branches which enables the customers to operate their accounts from any branch of the bank on its network regardless where they open their accounts. This is basically the benefit of having a CBS. Second one, it is an effort to increase RBI's control over commercial banks through computerization. Please understand, it cannot be called as RBI's effort to increase the control on the banks. Absolutely no way. It is wrong. And the third one, it is a detailed procedure by which a bank with huge non-performing assets taken over by another bank. No, this is also not associated with the CBS. Can you see the options here? The good old options, which were much more easier, rather than the new options where they'll simply say only one statement is correct, only two statements is correct, two statements are correct, three statements are correct. The good old options, only 1, 2 and 3 only, etc. So the right option for the question will be option A, 1 only is the correct option. Let me go to the next article. India, 7 other WTO members slam European Union and UK over the steel duty. Now, what is the issue all about? What is the background story to this? Listen to me very carefully. Whenever you talk about international trade, okay, whenever you talk about international trade, there is a concept called as trade remedial measures, TRM, trade remedial measures. The trade remedial measures are classified into 3 types. One is called as anti-dumping duty. Second one is called as a countervailing duty or anti-subsidy duty. And the third one is called as a safeguard duty. Safeguard duty. And within the safeguard duty, there is one more classification, or there is one type of a duty that is basically called as tariff rate quota. Tariff rate quota, TRQ, tariff rate quota. Now again, there are multiple types. Focus on the point which is there in the discussion now. Tariff rate quota. What is this idea of a tariff rate quota? Under the tariff rate quota, the imports will be allowed at certain rate of customs. But if the imports will cross a certain threshold level, the tariff that is applicable will suddenly increase, will be increased like this. And the whole idea is very simple here. Whenever you talk about safeguard duties, why are the safeguard duties imposed by the importing countries? The reason behind this is the importing country says there is a sudden inflow of these imports. Suddenly the imports have increased, risen, and this will harm the domestic market. In order to protect my domestic market, I will be imposing certain duties in the name of safeguard duties. And one such type of a safeguard duty is the tariff rate quota. This is point number one. Come to point number two. The European Union. Earlier, UK was also part of European Union. In 2016, they decided they want to move out of European Union, and finally in 2020, this actually happened. Today, UK is not part of the European Union. But understand the history here. In the year 2018, European Union decided to impose tariff rate quotas on the steel exports which are done by many countries, including India, by the way. They basically identified certain steel products and they imposed a tariff rate quota on these steel products. Now the other party, that is European Union, simply says, we have conducted an investigation and we feel that even today, right now, there is a need to extend and impose safeguard duties so that our domestic market is protected. And that decision is supposed to be taken to be implemented after June 30th, 2024. And looking at this particular situation, many countries, including India, by the way, they have criticized this decision of the European Union, because there is a concern that European Union may extend the application of tariff rate quotas. What about UK? In 2018, the tariff rate quota was implemented, safeguard duties were implemented. UK is out of the European Union, but it is expected that even UK will continue to impose the safeguard duties. In fact, the criticism in the context of UK is that they have not even conducted an investigation. They have not even conducted an investigation to prove that the imports are harming the domestic manufacturing. That is a criticism. In fact, Government of India, some time ago, Government of India mentioned that they have identified certain goods which are coming into India from European Union, and they have also identified around 22 products which are coming from UK into India. And as a retaliatory measure, Government of India said we might target these products and increase the tariffs. In fact, the goods which were identified by the Government of India which are coming from the European Union into India, if the retaliatory measures are imposed by the government, the amount of the coverage will be 292 million euros. Right, so these are certain very important points regarding the point of discussion of this particular article, where India and many other countries are criticizing the European Union as well as UK over the steel import duties or safeguard duties. Now, in connection to this article, I have given a descriptive question. How would the recent phenomena of protectionism and currency manipulations in the world trade affect macroeconomic stability in India? Many of you are generally under the impression that if you read a book from first page to the last page, you can answer any questions which are asked in UPSC, specifically GS paper 3 Indian economy. Now open any book, not the most recent one, but let's say the general ones which have been printed couple of years ago, and just check if there was an answer to this kind of a question. The point I'm trying to make here is very simple. Do not expect that UPSC will pick up a question directly from a book. That generally doesn't happen in case of all the questions. If UPSC will ask around 7 to 8 questions from Indian economy, hardly one will be a static question. For example, in the last couple of years, very famous static questions which have been asked by UPSC in 1 year. UPSC asked about the budget accounts, that is the revenue account and the capital account. In another year, UPSC straightforward asked about GDP methodology. But whatever the number of questions which have been asked, hardly one will be like this. Check out the remaining will be from the dynamic aspect itself, that is from the current affairs. So what would be the model answer to this kind of a question? How would the recent phenomena of protectionism and currency manipulations in the world trade affect macroeconomic stability in India? Point number one, please understand this. if any other government, let's say government of China, government of European Union, UK, etc., or government of USA, if they will impose import duties, if they will impose import duties, don't you think that will have a huge impact on exports from India? Think of it. If they will impose import duties, for example, the safeguard duties in this case, or earlier when Mr. Donald Trump was the president of India, they imposed duties on the steel exports from India, aluminum exports from India, covering from many other countries as well. So if the governments will continue to keep on imposing import duties, don't you think it will harm Indian exports? That is point number one. Point number two, and by the way, that is a part of protectionism. What about export restrictions? What about government imposing export restrictions? Not the government of India per se, but let's say we import a lot of precious minerals. We import a lot of minerals from a country such as China. If China will impose restrictions on the export of these kind of minerals, don't you think that will have a huge impact on Indian exports? What about currency manipulations? What about currency manipulations? If other governments are involved in currency manipulations, will it not have an impact on exchange rate in India? Will it not have an impact on stability of the financial market in India? Of course, the answer is yes. For example, the quantitative easing that was done by USA during pandemic, and after that, the Fed tapering that was done by them, don't you think that will have a huge impact on the stability of exchange rate in India? The forex reserves which are held by RBI, the demand for, or let's say the inflow of foreign portfolio investments or the outflow of foreign portfolio investments, of course yes. So these kind of protectionist policies as well as the currency manipulations which are done by other countries will have a huge impact on the stability, macroeconomic stability in India. And as a result of all of this, employment might be affected. The overall net exports might be affected. Imports might become very costlier, again which is having an impact on forex reserves, etc. Right, so these are certain very important points that you can use to write an answer to this kind of a question. Let me go to the next article. RODTEP, government to make random verification on the planes. What is this article? What is the issue all about? Government of India, starting 2021, replaced the earlier scheme by the name of MEIS with one more scheme by the name of RODTEP, remission of duties and taxes on export products. Under RODTEP, Government of India very clearly stated that they will not be providing any kind of subsidy here. The government said they are not providing any kind of subsidy. Rather, whatever taxes have been paid by the manufacturers, either at the state level, at the local level, or at the central level, which have not been given back to them, now they will be remitted back. They will be remitted back. This is point number 2. Point number 3. Couple of months ago, in fact, in the earlier Economic Weekly Recap, we had a discussion on this. Couple of months ago, the trading partners, right, other trading partners, they identified certain products from India and they started imposing tariffs on these products which are exported from India. And the argument that they gave was basically RODTEP. They argued that RODTEP is a subsidy regime. It is a subsidy scheme. And because India is a signatory of the Subsidies and Countervailing Measures Agreement, Government of India is not supposed to provide any kind of export-linked subsidies. And their argument was, we conducted investigation. We went to the manufacturers, we asked them, why are they getting the refunds? Why are they getting the remit money back? Why are they getting these remissions back under RODTEP? The manufacturers did not have an answer. They basically felt that it is a subsidy scheme. And that is the reason the trading partners identified 4 products which are exported from India and they started targeting these exports and imposing taxes on them or tariffs on them. Now, Government of India again clarified that RODTEP is not a subsidy scheme. It is not a subsidy. whatever taxes are paid which are not given back to the manufacturers, now they are being remitted under the RODTEP. Now how can we take care of it then? Other countries are saying, your manufacturers are saying it's a subsidy scheme. Government of India says it is not a subsidy scheme. How can we address this particular deadlock? Government of India now says, we will do random verification. What do you mean by random verification? The Ministry of Finance as well as the DGTR officials, now they will visit these manufacturers on whom the complaint has been raised by the trading partners. They will conduct a thorough check. And during the thorough check, they will try to find out how much taxes they have paid, which they have not received back. How much taxes the manufacturers have paid, either to the center, to the state, or at the local level, which have not been given back to them in the form of, let's say, ITC under GST. They will identify those taxes which are called as embedded taxes. These are called as embedded taxes. Embedded means these are part of the MRP. These are part of the price of the product. And they will basically also find out how much is the money given to them, how much is the amount returned to them under RODTEP scheme. Right? They must ensure that, basic idea is simple, they must ensure that the taxes which have not been given back to the manufacturers, that is the embedded taxes, and the amount given to them under RODTEP. And when I say amount, please understand this. Many of you will simply point out in the comment section saying that, sir, money is not given under RODTEP. I know. Right, the trade scrips, duty credit scrips, e-scrips are issued under RODTEP, right, done. So what is the value of the remission provided under RODTEP? The value should be same. This is what is being done by the government of India, right, to ensure that the manufacturers are given the same amount in the form of the scripts here of the embedded taxes, so that the other countries or the trading partners cannot simply say it is a subsidy scheme. It is not a subsidy scheme. It is basically a scheme where the embedded taxes are returned to the manufacturers. Right, so that is basically the gist of the article provided here. Let me go to the next article. IRDAI may price Bima Vistar at around 1,500 rupees per head. Now what is this Bima Vistar? Understand this carefully. Couple of years ago, IRDAI, Insurance Regulatory Development Authority of India. It's a regulatory authority. It came out with a policy to promote or to ensure insurance for all by 2047. The authority wants to ensure that everybody in India is covered under the insurance by 2047. Reason being, even today, the insurance penetration in case of India is very low. And in many cases, it has been found that people are not aware about what kind of benefits they can avail from having an insurance product. And the cost of the insurance product is one of the predominant factors why the people stay away from getting insurance. And there are so many types of insurances. For example, an individual can avail health insurance, life insurance, vehicle insurance, housing insurance, etc., etc. There are so many types of insurance products available. In order to address all of these issues, IRDAI came out with a proposal by the name of Insurance for All by 2047. Under this, they proposed something called as Insurance Trinity. They proposed something called as Insurance Trinity. Trinity basically means 3 points. One is, right, Bima Vistar. One is Bima Vistar. Second one is Bima Sugam. Bima Sugam. And third one is Bima Vahak. Right, these three are collectively referred to as Insurance Trinity. Right, that has been proposed by IRDAI. Now in this article, they talk about a Bima Vistar only. What is this idea of a Bima Vistar? Listen to me very carefully. IRDAI says it is holding consultations with all these insurance providers in the market leaders, and they're trying to talk to these insurance providers into providing only one insurance product which will cover all the other insurance types. For example, let me take a simple example here. Imagine rather than taking one separate insurance for the health, one separate insurance cover for life, what if there is only one insurance product which will provide both of the benefits to me? That is basically what the IRDA is trying to do here. They are saying only one insurance product will be made available at a cost of 1500 rupees. At the cost of 1500 rupees, which may provide, again please understand, it is just in the negotiation stage now, which may provide life cover, health cover, accidental cover, property cover, family floater, etc. Right, so many other options or so many other offers, or let's say different types of insurance products will be merged into only one type of insurance product. And the logic behind this, the regulator says the logic behind this is, if I include many types of insurance covers under only one type of a product, I can push it at affordable prices, I can push it to cover more and more population. And in order to promote the population coverage, right, the second pillar that they have proposed is Bima Vahak. Bima Vahak. What is this idea for Bima Vahak? I'm pretty sure all of you heard of bank sathis, banking correspondents. The bank sathis played a very pivotal role, or played a very important role in promotion of the coverage, right, or let's say in promotion of financial inclusion in India. On the same lines, the IRDA says that Bima Vahaks will be promoted. And Bima Vahaks, specifically they are targeting women to act as Bima Vahaks. And the argument that has been put forward is, women will play a very important role in convincing other women, especially in the rural part of India, to avail insurance products. That is the reason they are targeting another concept called as Bima Vahaks. And the third pillar associated with this trinity, right, basically apart from this nothing else is there here, don't worry. The third pillar, right, under the insurance trinity is Bima Sugam. Bima Sugam is basically a portal, a one-stop portal for all the information regarding all the insurance products which are offered by different companies. Right, that is basically the Bima Sugam portal. And the portal will not just provide you information regarding the insurance, your claims can also be raised using this particular portal itself. So these are certain things regarding the concept of insurance trinity or Bima Vistar, which was there in the newspaper very recently. The last article for this week, not activating counter-cyclical capital buffer for banks now, says the Reserve Bank of India. Now, what is this counter-cyclical capital buffer? I'm pretty sure all of you heard of capital conservation buffer. Again, if you're wondering, sir, where will I have read about capital conservation buffer? Basel guidelines. Article 1 and articles, right, number 6, both are connected to Basel guidelines. Under Basel guidelines, they have introduced two types of capitals, two types of capital requirements. One is basically a capital conservation buffer, and the second one is counter-cyclical capital buffer, right? It is basically written like this, CCYB, counter-cyclical capital buffer. Now, many of you will simply say, sir, both are one and the same. No difference, both are one and the same. Absolutely no. Under Basel III, these two types of conservation buffers were actually recommended. And right, some of the countries have used, right, only one of them. Some of the countries have activated, right, either of them. In case of India, RBI said, we will activate capital conservation buffer. It has already been implemented. Under capital conservation buffer, 2.5% of risk-weighted assets. 2.5% of risk-weighted assets. This is the amount of buffer each of the banks are supposed to maintain. And the logic behind this is, if the bank will incur more losses in a particular year, right, because it might happen because of various events, the losses incurred by the banks are very high. At that point of time, the buffer, that is a capital conservation buffer, can be used to absorb the losses. This is basically the logic behind capital conservation buffer. But look at the other side, counter-cyclical capital buffer, right? It is also type of equity only, right? It is also type of equity. That is also tier 1 equity. This is also tier 1 equity. But what is the logic behind the counter-cyclical capital buffer? The Reserve Bank of India, that is again taking from the Basel guidelines, the argument here is, whenever there is a very high credit growth in the economy, whenever there is very high banking activity where the banks will become very active and keep on providing lot of loans, and this generally happens when the economy is going very fast. When the economy is growing very fast, the banks, in order to make a high amount of profits, will become very ambitious, keep on providing lot of loans. What if the economy will suddenly take a downturn? Because during the high growth phase, the banks have given so much value of loans, so much number of loans, because the economy has taken the downturn, borrowers are unable to repay, and because of what has been done during a high growth phase, that can hurt the banking sector when the economy suffers. That is the reason under Basel guidelines, we have one more type of a buffer, CCYB. What CCYB says is, during very high growth phase, if the banks are providing lot of loans, impose this. I hope you understand. During high growth phase, that is during a particular phase where the credit is increasing at a very faster pace, loans issued by the banks are increasing at a very faster pace, impose this kind of a buffer. And this is in the range of 0% to 2.5% of risk-weighted assets. And what is the use of this buffer? What is the object of this buffer? If the banks are giving very high value loans, high number of loans are being issued, if they impose this kind of a buffer, that is RBI activates this kind of a buffer, the banks will have to keep aside more capital now. They will have to keep aside more of capital. And now the banks will be concerned about keeping more of a capital. They will tone down, they will reduce the amount of loans that they are issuing. That is basically the objective of counter-cyclical capital buffer. Look at the term, counter-cyclical. Cycle is that it's a phase where more loans are issued. I do not want the banks to issue more loans. I want them to temper it down. I want them to reduce it down. That is counter-cyclical capital buffer. In the recent things that are happening in the Indian economy, especially in the banking sector, you must have seen there is certain concern regarding the kind of lending activity that is being done by some of the banks. For example, in certain situations, even the Reserve Bank of India itself has cautioned about giving lot of unsecured loans, lot of consumption loans, because if these loans turn bad in the future, the banking sector will have to suffer lot of losses. In that particular context, Reserve Bank of India very recently has clarified that they are not going to activate the counter-cyclical capital buffer for the banking sector as of now. So these are certain very important points, as well as the questions related to these particular articles for this week. If you like this initiative, please hit the like button. And if you're yet to subscribe to our YouTube channel, kindly do it now. Thank you. Have a great day.